have missed a few months, but January 2022, and wish you all a very, very happy New Year, happy Makar Sankranti, and happy Pongal. I hope all of you are keeping good health. Personally, I'm recovering from COVID, but I'm doing well. So it's been interesting quarantine the last 15 days, but I'm hoping all of y'all are also keeping good health and doing well. Just put in a quick message saying yes, doing well. Yeah, can I see some messages? Yes, thank you, thank you. Great. Great, yes, good. I'm glad to see you all doing well, and yeah, I'm getting well. So welcome to 10 Crore League one more time. And 10 Crore League is a community of like-minded people who aspire to build wealth the right way, doing the right thing so that they can be a blessing to their family, to their society, and to their country. And we started back in 2020, middle of 2020. We've gone some distance, we've taken a break, and then we are back now. Just to give a quick perspective, in the 10 Crore League, when we say we do the right things the right way, there are a few principles that we live by and we adhere to in the 10 Crore League. And I'll quickly take you through them just in case you've forgotten them. So here, these are some things that these are principles that we follow, that we'll spend intentionally. In our family, we will work as a team, and we'll save like a pessimist, but we'll invest like an optimist. We'll keep our promises and reach our goals. We eat healthy, we exercise, and we take adequate rest. We take responsibility for our decisions and our destiny. Our children are responsible with money, because if they were to inherit something like 10 crore, they better be responsible with money. We are all filled with gratitude for whatever we have, and we give generously without any expectations, because we know very well what goes by comes around many times over. So these are some basic principles that we live by. And in the process of building wealth, there is a well thought through 9-step process. Each of us will find ourselves being at different stages in the process, but you can identify where you are. And I'll quickly take you through that. Some of you have gone past step 7, 8. Some of you are already in the giving plan stage, but some of you are just starting off. So the 10 Crore League is for everyone who's aspiring. So it could be anybody's journey. So at the step 1, you get your first 1 lakh in cash for emergency. At step 2, you purchase your term life, your health, and your disability cover. At step 3, you pay off all your loans except the home loan. We know why the home loan comes at the end, right? At step 4, you create a 6-month emergency fund. At step 5, you start investing at least 15% of your income for retirement. At step 6, you build the corpus for your children education fund so that it's done and they're well taken care of wherever, whatever their age is. At step 7, you attack the home loan and pay it off in full. And at step 8, you focus on the 10 crore target, which is building that kind of wealth. And step 9 is creating a giving plan. Right, so these are some steps. We know they are well thought through, and it's a step-by-step process where you do one thing at a time, do it well, finish it, and then move on to the next. And that is how we think we will progress in life, doing one thing at a time. Right, so we are connected in WhatsApp, and we are on Facebook and LinkedIn. So please stay in touch with us there, and you connect with all of us. So this, I am closing this. Nothing much to share here. So very quickly, guys, how has 2021 been for you? So it's when we're connecting after about 4 months, and what has happened in your life in 2021? Why don't you quickly put it on chat while I share some things from my my life. So quite a few things have been happening in my life also. Professionally, I have finally taken the plunge to move from being a mutual fund distributor to a SEBI-registered investment advisor. In fact, it was all triggered in one of our 10 Crore League meetings only, where Harish Menon, who's our guest today, came as a guest back then. Back then he was the guest, today he's Garka. So last year, we did a session on derivatives. I hope you all remember that session. It was one of the very well attended, well received sessions. I think in July or August. And as a follow-up meeting, when we went to discuss, say thank you for coming on the session and all that, we were discussing possibilities of working together, and one thing led to another, and House of Alpha was formed. So this is a fairly big professional leap in my life in 2021. And if I have to say, my biggest learning from 2021 has been that if you want to go fast, you go alone. That is the saying, right? If you want to go fast, you go alone. But if you want to go long, you go together. So collaboration is the key. The future is all about right thinking people, right-minded people coming together and doing some phenomenal stuff. So I'm on this long journey, and I have some great company. This is my big takeaway from 2021. It's been a phenomenal year for me. So how about you all share with me very quickly what has happened to you in 2021, and what has been your biggest learning from 2021 that you are carrying forward into your future? So share a little bit of wisdom here with all of us, and I look forward to hearing from all of you. Swaminathan says, good, you invested in shares and mutual funds. Wow, okay, good, excellent. That's good to hear. Please do share. I'm hoping all of you all are typing, or if you want to unmute yourself and have some key learnings from 2021, please do share. We are all ears, and this is a place where we learn from each other. Even if it's a mistake and you've learned from it, it's a learning. Please do share so that we don't do the same mistake, right?
So
my view on life. Yes.
Sorry, someone is saying, can you please show the previous slide once, 9 way of living principles?
Yeah, sure, I can. Yeah, you go. That's right there. Okay, so I'm also reading the chat. As those of you who want to share your biggest learnings, please go ahead. Rashmi said she achieved her targets. Wow, Rashmi, I hope that was, that was something that was big for you, and congratulations. Senthil says, my view on life and health insurance got changed in 2021. So now taken more life and health. Okay. So insurance is, the realization for insurance has come. That's what Senthil is saying. Bharat says, you became an author and invested in long-term return investments. Congratulations, Bharat. You became an author. That's amazing. Good. So why don't you unmute yourself and tell us something about the book that you wrote? Amit exited real estate investment. Good. Bharat, are you?
Yeah, thank you, Bhavna.
Hey.
Good to see you, and good to come after a long time.
Yes.
This was actually something which I wrote on my experience of entrepreneurship.
Okay.
And somewhere the savings of money is also involved in that. So that's what I wrote. And 31st October was the launch. And it's selling on Amazon, not the bestseller, but got a good reviews from a lot of people.
We'll make it the bestseller. What's the name of the book?
The ECG of Entrepreneurship.
ECG of Entrepreneurship. Okay, ECG of Entrepreneurship. I'm writing it down. Guys, go find it on Amazon, and let's make Bharat bestseller on Amazon.
Thank you, Bhavna.
Great. Thank you so much. Thanks for sharing with us. Priya says, I have lived by the 9 principles of our club, completed my 5 steps to reaching the goal. Amazing. Good. Priya, you're such an inspiration. And I know a lot of people here in this call who've stuck to the 9 principles, who moved one step by, one step at a time, who moved ahead. And some real life stories that we've heard and shared in the group. So, and those people are being very shy today. I don't know why, but that's all right. Does anyone else want to share what your great learning for 2021 has been? It's been an interesting year in many ways. We thought 2020, though we survived, 2021 will be different, but it wasn't. Anyway, so what is 2022 going to be like? Right? That's like the big question in everybody's mind. Can we copy and follow your 9 principles in our life? Please do, Ajay, please, please do. I'll share it. We'll share it in the group as well. Harsh says, I streamline all my investments and align them to my mid and long-term goals, learn to be more alert while doing any work, be positive learner, and started reading books. Excellent. Harsh, that's amazing. Yeah, even one of those people I was talking about is Harsh here, who's been a great support to this league, and who's been, he's believed in the process and he's stuck to it and he's moved ahead. So that's really amazing. Ajay, thank you very much. Please go ahead and feel free to use the content. And okay, so when we started this 10 Crore League, it was mid of 2020. Okay, and it was a very different time. If it almost feels like it was 10 years back, it was just about a year and a half back. But what was it like back then? It was, we were in the middle of the first lockdown. The pandemic was, the first wave wasn't as bad, but then the fear was big. There was no vaccination in sight and people were losing jobs. And we were scared that we'd die. We may not survive this pandemic. And the stories we were hearing were not good. And, the economy wasn't looking great at all. And then the focus was on getting to the basics, get your budgets in place, create your emergency fund. So, that was the focus. And that's how our 9 principles, what we put together came about. Now in 2022, does it still make sense to, say all of that? Because today everything is looking good, right? The economy is growing, GDP is showing very, very healthy growth. Have you heard of the Great Resignation in the US? People are talking about people resigning their jobs, not losing jobs. They are voluntarily resigning their jobs left, right, and center because they want to do something on their own, or they're getting, the job market itself is very flush with a lot of opportunities. I think people's mindsets and their priorities have changed a lot. So it's been a significantly different. The situations have changed a lot since the time we started 10 Crore League in 2020, and investing also for that matter. So who's doing value investing anymore? It's all about valuations and startup investing, unicorns, 41 unicorns in a year. It's unbelievable what India has gone through in the last 1 year. And if we're not abreast of what's happening, and if we don't come up the curve, if we don't come up the curve and understand what's happening around us, we will get left behind a little bit. Don't you think so? Yeah. So I thought it makes sense now to just connect and think of all those things that have happened in the last year and what it means for us in the future as we are in this path to wealth creation. And I couldn't think of anyone better, because Harish is, and he is a good friend, notwithstanding that he's a very, very keen market watcher. He's a very well-respected trainer. He teaches, he trains some of the top wealth management firms in the country. So if you're hearing anything sensible coming from their mouths, you know where it's coming from. So you as well go and ask the source, right? So, and we have access, so we better make use of it. And Harish is a SEBI-registered investment advisor, a CA and a CFA, and has been in the industry, for a fairly long time. One of India's leading derivative strategists. He did a session on derivatives for us, and he's put together something that's mind-blowing. He shared the presentation with me, and I thought that was top-notch. It's something that you'd hear. You wouldn't even hear some of the best fund management houses. I've been attending those sessions in the last 1 week, 10 days. It's far better than what you'd hear from all of them. And I'm going to let Harish come in here. Harish, yes.
Thank you, Bhuvna. Hi.
Let me pin him and spotlight for everyone. There you go, Harish. Yes, that's Harish Menon for you. He's lost some pounds since we last met him. Good job, Harish, on that. So good to see you. And he's put something superb for us, guys. I'm not going to stand in the way, and I'm going to let Harish take us through some thoughts that he has. And when it's coming from him, I want you to pay attention to what he's got to say, because there's no one word that he utters which he's not thought through himself, right? So go ahead, enjoy the session, and please keep putting in your questions in the chat box, and I will keep intercepting and asking those questions on your behalf. Is that okay? Are we good? Okay. Karthik says became a professional 2021. Just 1 minute. I'll just take these points. Became a professional 2021, fought COVID along with my family, and my learning from 2021 is that everything in life follows the bell curve principle, even happiness. Okay. Okay, good. Learn to see life success in 4 parameters for myself and my clients: health, relationship, cash flow, and net worth. Excellent. That's good. Yes. Okay. I've covered most of this. And yes, so we can go. And are you all ready for Harish's insights? This is going to be phenomenal, guys. Please keep asking your questions, taking your notes, and I'll see you in a little while. I'm switching off my video, and there you go. Over to you, Harish, all yours.
Thank you, Bhuvna. Good afternoon, everyone. Wish you all a very happy 2022. I hope all of you are safe. This new wave of COVID is spreading very fast. As close as our office, where Bhuvna also has tested positive last week. So last time when I came to this 10 crores league session, I think it was somewhere in the mid of last year, to talk on derivatives. It was more like an external forum where I'm coming and speaking. And as Bhuvna said earlier, I'm very fortunate that she agreed to join us and collaborate with us in our journey. And we are looking forward to do a lot of exciting things for the investors community. So me, Bhuvna, Saumil Parikh, who's also a participant in this program as we speak, we are all doing and hoping to do something interesting for the clients. So I hope all of you would have your best wishes with us. Today's agenda is to try and look at what has happened, but more importantly, look at what probably will happen going forward. So I have put together a set of data charts from reports, which I basically read a lot. Before I go into that, I report into SEBI. All of you know about SEBI. So SEBI wants me to speak about certain things before I start talking about any market related stuff. Nothing that I will speak today is an investment advice. I hope all of you would go to your respective financial advisors and take advice if you want to put any actionable out of whatever you hear today. I am not necessarily telling you to do something. Very clear disclaimer. I have used a lot of reports, and the source of a lot of these charts that you will see in the next 45 minutes or so has come from various reports. I have put the source very clearly wherever I can. So I don't claim to have prepared these charts from scratch. The data obviously is market data. There is no proprietary data or insider data which has been used. So it is not like I have used something which the company has not disclosed or not made public. The data is all in public domain, but some other firms and organizations and teams have put it together. I read a lot of report on a daily basis. So I have just kind of collated a lot of things and developed my entire investment philosophy around that. So I would be very clear about that aspect. A lot of views which you will hear today is my personal views as one of the investment observers, and there are many of us who do that every day. So feel free to negate those views. Feel free to be on the other side. You may not agree to a lot of things which I'm saying. That's totally all right. I'm just trying to put something forward. I'll obviously try to convince and justify why I'm saying whatever I'm saying. So that much I'll try, but we need not eventually be on the same page on a lot of views that we could discuss. I make a lot of assumptions when I create an investment portfolio for clients. For myself, you have to assume there have to be certain assumptions that you will make. When those assumptions go wrong, you have to keep looking at data and see whether assumptions are still valid. If it goes wrong, you course correct. You do something in between, and hopefully, eventually, when you look back, we haven't done too many costly mistakes. Mistakes we all do. We will have assumptions that will be wrong, but the only thing we look back is, okay, we did not make a blunder out of the entire thing. And always remember, whenever you are not very sure about what is going to happen, always try to play safe when it comes to investments in anything. So what happened in the last couple of years, we all know. I will not spend too much time on that aspect. I'll just quickly take you through this part. But it was basically a liquidity fest. There is no two ways of looking at what has happened in 2020 and 2021. It was all triggered by massive amount of liquidity. It was a party. It was a party, and you will see some data that will actually tell you that it was a wonderful party. And I really hope that all of you were a part of that party and you were invited and you actually enjoyed that party. Before I go into specifics about financial markets, I truly believe that macroeconomy is the broader landscape under which everything happens. So policymakers look at macro, markets look at macro. You will have to, if you are a fundamental investor, look at what's happening to the macro story. And this is where I want to tell you very categorically that COVID was not the trigger for a slowdown or a fall in GDP. If you look at the data, this is India's GDP. We were slowing down right after 2017 fiscal year. So even a couple of years before COVID was even introduced as a concept in this world, Indian growth was slowing down. There is no two ways about it. So when we talk about economic cycles, please don't read the current economic cycle starting COVID crash or COVID GDP correction. No, it actually preceded that COVID correction by probably 3 years. In other words, if you ignore COVID, if you just imagine a world where let's assume there was no COVID, then this chart that you see at an 8.3% real GDP growth was slowing down to 6.8, then 6.5, then 4, and this probably negative bar would have been positive, but it would not have been at 8 or 9%, please understand. And because that would not have been at 8 or 9, this 9.5 and 8.1 would not be the data that you will see, because year on year you saw 9.5 because the previous year was very negative. So what I'm basically trying to say is, even if you take out COVID from the equation, we were slowing down since FY17. Meaning, when you read economic cycles, we were actually at the slowdown phase of the economy. So when you now read the next few years, don't say it will be good only because COVID was a bad year, so everything will look up. Of course, it will happen. Because of a very, very bad year, things will look better. But don't forget that we were also actually slowing down in the broader economic cycle, and we would have recovered probably in the coming years. And a lot of data is actually suggesting that. The policy makers, because of COVID, obviously started doing a lot of things to create growth, to create employment. So one of the things they did was they printed money. So this data is about what is technically the sovereign debt, which means government borrowing as a percentage of GDP. So if you look at developed countries like US or even Japan or China, whatever their debt to GDP ratio was in 2017, it has gone up over the last 5 years. Why it has gone up is because the government has borrowed a lot. Literally, it is called printing. You would have heard about a term called quantitative easing. So there's a lot of printing which has happened that has created a lot of liquidity, which found its way into financial markets. So while the jobs were being lost in 2020 and early part of 21, while the economy was not doing well, asset classes were still doing well. Whatever asset classes you could put your sight on, they were doing well because there were a lot of money coming into the system. So money first went to financial markets. Now slowly, gradually, it is going to the real economy, as data will show us. The same thing happened with the monetary policy. Monetary policy, as you all know, is taken care by the central banks of the country. So all the major central banks, including RBI back in our country, we did a lot of stimulus packages creation. So we cut down interest rates, we created liquidity, CRR was cut, a lot of bond buying happened, which also creates liquidity. So the theme was very simple. There is a major pandemic, growth has been hit. Let's create as much liquidity as we can. And that liquidity first came into the financial asset classes. And then now, as we speak over the last 6 months, it is slowly seeping into the real economy, which is a very good sign, which is a very, very wonderful thing. So if you see this total monetary policy impulse, when I say impulse, it basically means how much stimulus was created in the form of liquidity and rate cut. You can see how calendar year 2020 was unprecedented stimulus that was given. And that has already started to come down. So in 21 as well as in 22, we are not going to see that much stimulus because growth is coming back. The first impact of too much liquidity was felt in equity markets. So the listed equity space, which is technically known as your secondary markets as we understand it as, there the market cap of the companies just shot up like crazy. So this is a ratio on the left hand side. If you see, this is the global equity market capitalization, which means for the 4 major economies, to money supply. So it's basically a ratio which calculates how much market cap is being created with money supply as a base. On the right hand side, you can see a very commonly used ratio made famous by Warren Buffett, market cap to GDP. So again, the market cap of the 4 major economies, equity, to their total gross domestic product, total value addition they did in the economy. Again, as you can see in that last cycle, we have crossed all previous levels of valuation. This is one of the concerns which you will hear everybody talking about, that valuation is too high. We have never seen such levels of valuation and so on and so forth, which is again triggered by liquidity. I personally believe that 2 important sectors which got a lot of liquidity was in the primary market space, both the listed company space as well as the private equity space, unlisted one. They got a lot of liquidity, as you can see here again. Over the last 21 years of history, 2020 and then 2021 is where the highest amount of fundraising happened through IPOs, which means the companies are going public. Also, we saw the highest amount of fundraising in the startup space. I'm calling them jokers of the party, not in a bad way, because jokers in a party is the heart of the party. That is where everybody is entertained. Everybody is looking at the joker. So I'm not saying joker in a bad way. I'm saying joker as in the highlight of that party in wherever you go. So if you ask kids, what did you enjoy? They'll say, oh, the clown was very funny. Same way, the startup industry got a lot of liquidity that was created from stimulus packages from both the government, which is fiscal policy, and central banks, which is monetary policy. Interestingly, if you look at this data for 2020 and 21, India has now created more unicorns than China, which is like a very, very big thing, to be honest, if you understand the startup ecospace in China. Unicorn, as many of you would know, is when a startup reaches a valuation of $1 billion US. A $1 billion US is when you say it's a unicorn. So that is roughly 7,500 crore of rupee valuation for a startup. So as Bhuvna also mentioned in the introduction, we saw record number of companies in India becoming a $1 billion valuation company. And not only in absolute sense, but relatively, we have overtaken China in terms of that number, which is a very big thing. Please understand, China is a mammoth country in terms of how they create entrepreneurship. So clearly the liquidity has helped pretty much anybody who wanted to start up in the last couple of years. There is a lot of liquidity lying around even now as we speak. This was a party for everybody, a word which we use in Mumbai, Sarvajanik. Everybody was invited, whether it was equity, whether it was commodities, whether it was Bitcoins, cryptos. I'll talk about that later today. Everybody had made money. If you meet someone in your circle who has lost money in the last 1.5 years, a special salute to them, because you can just do the exact opposite of whatever they're doing in investments. If you ever find somebody who has lost money in the last 1.5 years, be very close to those people. Do exact opposite of what they do in life. You will make money, because they have managed to lose money in a market where just close your eyes, pick up random stocks, you would have made money. Who needs fund managers now? Who are they? Who's Prashant Jain? I can make more money than that was the theme of 2020 and 2021. So you can see everybody, I mean, Indian stocks, global stocks, everybody was making money. One asset class which did not do well, and I'll talk about that later, is gold, right? You can see -4% was the returns for 2021 in gold. Now, this is a very interesting chart which talks about US S&P 500, like we have Nifty, Sensex. The US index is called S&P 500, as many of you know. If you look at these dots, these are the predicted values of S&P 500 1 year hence. So all of you know that when the year ends, all major global research houses come out with their predictions for the next year. So this is just a collation of what they predicted for the next 1 year for equity versus what actually happened. So if you look at 2019, 2020, 2021, and all the years, despite COVID, despite so much of gloom and unemployment which was going on, the actual S&P 500 index outperformed even the most optimistic the forecast that was done by these global houses like JP Morgan, Morgan Stanley, Credit Suisse, etc. As you can see, it has kind of surpassed everything. So this is not fundamental, right? You would have heard a lot of people saying fundamentals have gone for a toss. Nobody's talking about any ratios now. It is all money, money, and money. So when you suddenly get a lot of liquidity at literally 0% interest rate, you will eventually take that money and say, okay, why not take some risk and invest it in the markets? That's what exactly happened. I am not complaining. I have got the benefit of that. I'm just trying to tell you what has happened. Of course, we are interested in knowing what is probably going to happen. Now, this is a very important chart which I want you to focus on. This is all previous bull market rallies in India. So from whenever the bull market started, what this chart is showing you is how much did it go up in that entire bull market cycle and in how many months. So if you see this particular chart, it all starts from zero in various cycles. You can see various different cycles mentioned here. This blue line, this one, if you can see my cursor, I don't know whether you can, but this blue line is where the March 20 cycle is. So it started and then it is going like this. If you see here, there was this crazy Harshad Mehta stock market cycle, which went up like crazy. And then of course it crashed. So don't wait for the crash chart. The chart will tell you till where it went up and then that's it. So how much time it took to go to its highest levels. I've been reading a lot of reports and that's something which I do and I get paid for that. There is a lot of similarity between this bull market that we are in and the 2003 to 2008 bull market that happened. And I'm not saying it just based on this chart. I will try to hopefully tell you how I am saying that. I think there's a lot of similarity between what has happened in 2003 to 8 from a macroeconomic structure point of view and what is going to happen probably in the next 2 to 3 years. So just to give you a little bit of a trailer about where this movie is going to go, I'm not telling the climax, but yes, I am not as negative as a lot of people are about the equity markets, even after 2020 and 2021 rally. If you can see, we are just about going to be close to this 2009-10 rally where it ended. And then that's it. Then there's only this one mega 232 weeks rally that we saw. 232 weeks, I hope you understand, is almost 5 years. This was after the dot-com bubble crisis. How many of you were in the market in 2003 to 2008? Can you quickly tell me in the chat? I'm just curious to know how old I am. I'm old. I was in the market at that point. How many of you were there in that market? Can you say a yes? Were you there in equity markets in 2003, 4, 5, 6, 7? Who are old as me is the question. Kartikeya was 6 years old, he says. Sriram was in the job market, okay. Some oldies like me, I guess, who are saying, yeah, we were there in that market. Bhuna was a spectator, not invested then. Amit started in 2008. Interesting. Cool. So this chart is a way of looking at it and say, okay, have we run up a lot and are we going to crash, or is there a lot of steam left? I am, just to give you a trailer, in the latter camp. I am looking at this entire thing and saying, okay, there is steam left, and I'll tell you why I'm saying so. Of course, there are concerns and there are assumptions which I've made, but let's see. This is India's market cap to GDP, market cap of all the listed companies of India to the GDP of India. So as you can see, it was crossing this 100% level just once, and then it was touching that 100% level, and then the COVID crash happened. As you can see, because of COVID, it kind of crashed down. Again, we went back to closer to 100. So we have not reached any euphoric levels that we saw in the 2007 rally. 2007 was like the peak point of 2003 to 2008. And after that, it kind of dropped, and then the subprime crisis crashed in the September 2008 period. So we haven't really reached that crazy valuations, but yes, there are a lot of parameters which tells us that valuation probably is very high. This is one more index which is calculated by Axis Securities. So what Axis Securities does is it takes an average of multiple parameters of Nifty, for example, price to earning, price to book, and market cap to GDP. So there are three different valuation metrics. The combination of that is this India Valuation Index created by Axis Securities. As you can see again, 2007 was when we saw that peak in terms of PE, PB, and market cap to GDP put together. And now in October 21, that level was again reached, if you can see. So from October, again, November, December, if you have seen, the markets have kind of corrected. We have not again crossed the all-time highs that we saw in October. So if you look at that peak, which we actually scaled in 2021 October, that was where this combination valuation had reached that all-time high levels, and it did correct. So this is a very interesting ratio that you can also track if you wish to, where you take the PE, where you take the PB, where you take market cap to GDP, create an index out of it on equal weight basis. Just take a simple average of the three on an index basis. If you want, you can create your own index like this. I track this closely, where I decide a lot of things in my portfolio based on this. These are the Nifty returns on a calendar year basis for the last 21 years. Calendar years. These are monthly returns of Nifty. And on the last column, if you see, you will see what is the annual returns for Nifty annual. Now, if you saw, for example, 21, 24% returns for the entire year. 2020, 14%. This is Jan to December. So obviously there was a crash and then there was a rise. So point to point was only 14%. I say only 14 because of the euphoria we have seen. 12, 3, 28. So if you see, this is 6 consecutive years of Nifty going up. And we have not seen this happening for Nifty ever. 6 straight years of calendar years growth. Of course, not all in double digits, 3 and then 28 and then again a 3 and so on and so forth. Now this, if you see a little higher from 2003 to 2008, is that boom equity market that I was referring to earlier. You can see the return 72, then 11, 36, 39, 54. This was back-to-back bumper years. This is where personally I had made a lot of money, which eventually went off when I got married after that. So I will talk about that separately. So this 5-6 years, can we replicate that, is what I have been constantly thinking for the last year or so. Every week when data is coming, I am just trying to poke hole in my theory, whether this will be a repeat for the next 3-4 years of what we saw. So you can say, oh, already 6 years have gone by, but I am saying there is probably still a big couple of years coming up. It is probable, it is likely, and I would be putting my money on that. One interesting thing which has happened in 2020 and 21, and that is why I said, why do you need fund managers anymore, is the percentage of top 500 stocks in India which actually closed positive has been very, very high. This one has been a very broad rally. So if you see this data, this blue line that you see is the percentage of stocks with positive returns. So out of top 500 stocks listed in India, out of that 500, how much percentage closed that year in positive? So for example, when 2012 rally happened, 79% stocks had closed positive, 82, 87. But if you look at the last 2 years, 97 and 89% of the stocks have closed positive. That's why I said you randomly would have picked any stock and point to point, they would have made money. So if you are a new investor or who seriously started investing in the last 2-3 years only, and you have got 40% CAGR, 50% CAGR, please do not overestimate. Please do not overestimate yourself. Let's be humble. This was 2 years where, as I said, if somebody lost money, that was a very big achievement because it was not absolutely difficult to make money. Pretty much all these stocks went up. Just imagine 97% and 89% of all 500 stocks have gone up. What are the odds that you would not have that stock? It's a very less probability that we're talking about. One more point about 2021. This year started when the price to earning ratio of Sensex was 33. So we generally say in historical sense that when price to earning ratio crosses 25, 26, that's overvalued levels, 25, 26 on an index basis. And you can see that in the history, if you see 24, 21, 25, 23.6, 26. We have always been there when the correction actually happened or some kind of profit booking happened. In the end of 2020, beginning of 2021 calendar year, Sensex, which pretty much is more or less close to Nifty PE also, was already at 33, yet there was a big rally, yet 89% of the stocks did well. This is a very unprecedented thing that has happened because of liquidity. Again, one of the biggest triggers was definitely liquidity. So we have started to believe that, you know what, we can beat fund managers. Why should we pay their expense ratio? A big part of this rally, as you're already aware, and some of you in this forum has already contributed, including me, a lot of this has come from retail investors. So if you look at this blue bars, this is retail buying, retail through direct equity plus mutual funds. This is a data which has been put together by UBS. As I said in the beginning, it's not like I have made this data in Excel. I have read reports, I have taken it, and this is not for public circulation. I am never going to put this in the public domain and say I made this. No, this is only to share my views and take some supporting. So if you look at this retail data, it usually is negative, and typically FI flows were always the ones which were triggering the rally in the previous cycles. Last couple of years, as you can see, the retail buying has been very, very strong. And I think most of us realize that mutual funds have been getting a lot of money from SIPs. Advisors have been telling the investors to get into equity after that 2020 crash. More importantly, they're continuing even when markets were at all-time highs, they continued. They have not exited from the market yet. Now, there is a theory which I've heard a lot in the market. A lot of people say that whenever retail enters the market, that's the time to exit. They always go by the historical sense that you can see in the previous cycles that FIIs exit, retail goes to peak, and that is when the markets probably will top. And after that, you will see a significant correction. I think it was true probably for the previous cycles. There is one big difference in the current cycle is what I believe. And that big difference is not just the quantum of money which has been put by retail. It is more importantly about the number of investors who have entered the market. What do I mean? This is the total number of demat accounts which has been opened in India. If you look at FY 10, 11, and then a lot of these fiscal years, this orange bar that you see, for example, 19 and 20 million. So this is in millions. So 19 is 1.9 crore demat accounts, 2 crore demat accounts, 2 point something, again 2 point something, sorry. And the last data, if you see, is 51.5 crore total demat account. This is cumulative demat accounts over a period of time, cumulative. So please understand, this 19 is a part of this 20. This 20 is a part of this 20.1. It's cumulative. So this 51 includes all the previous demat accounts open. The blue graph that you see is the new demat accounts that were opened in that year. For example, in FY 10-11, there were 19 crore demat accounts at that point in time. Total created as on that date, out of which 0.3 million was created in that year. So if you understand, out of 19, which is almost 2 crores, just 0.3 million was created only in that year, which is not a very high percentage. And that continued for some time. For example, if you look at, let's say, this bar somewhere in 2016 or 2017, out of almost 6 crore total demat accounts, the new demat accounts that were created is just about 30-40 lakhs, like just about 3-4%. Coming to FY 2021, and then later also, if you see what happened between April and October, the number of new demat accounts that are getting created is at record high levels. And I'm sure many of you have met investors who have gone direct equity. Now, why am I talking about it? Because when new demat accounts are created, it is not the same investors putting in money and then pulling it out. There are newer money coming into the market. So if let's assume I am booking profit, there is 5 more demat accounts and they are putting in money. That is a very interesting trend which we have seen this time. Now, I am not trying to say that this will continue and we will see a major bull market. I hope my validation is right. But there is a sense of new money coming in, which is supporting a lot of FI selling. You would have seen every dip in the market, there is buying coming and again the market is pulling back. It's not about the people who sold again coming to buy back. Understand? These are literally 50-60 lakh demat accounts being opened every month. And I hope you understand we are still under penetrated in equity. We still don't have more than 7% of our population having demat accounts. We have a long, long way to go in that space. So the most important question is, this party which was created by liquidity, is it over? Now, is it time to go home and just all the profits, go to debt or FD, and you know what, just tell our grandkids, there was one good couple of years where I made money? Or is the party going to continue? Is it just a small break? Let's again look at data. I rely on data. Even if I have an assumption, I will have to see whether the data is supporting the assumption or not. First fact, and this is a fact globally, is that inflation is back, which means demand is back, which means consumption is back, which means jobs are back. Inflation is back indicates a lot of good things about the economy. It basically means that the joblessness which was created is now reduced. People are back to getting income. People are spending a lot. Inflation is going up. So obviously there is a base effect. So 2021 over 1920, you will see a spike, but it has not only created a spike, it has exceeded all expectations of major central banks. US Federal Reserve, if you're aware, has openly said that we underestimated inflation, and they've already started giving indication that interest rates will be increasing going forward. So the first possible risk to the party getting spoiled is excess inflation leading to excess interest rate increase. Because when interest rates go up, please understand, fixed deposit becomes more attractive. So the money can go from equity to fixed income, which is called chasing yield. I'm not talking about retail, I'm talking about institutions. So when US Treasury yields become attractive, in the history, if you see, a lot of money goes to US Treasury because it's safe. And they think that why should I take risk on the equity side? So there is something called as de-risking or deleveraging that happens. So if interest rates will go further higher than what is the base anticipation as of now, there is a possibility that there will be deleveraging, and that could trigger whatever correction that we may see in the equity market. Now, will it happen? Will it not happen? I don't know. I cannot predict the future. But my base sense is, especially in India, inflation is not going to be a worry at all. So yes, it will go up. Yes, it will climb. But I don't see inflation becoming a serious concern where suddenly the central banks will say, you know what, I was expecting to increase the rate by 1%. Let me suddenly increase it by 2%. I don't think at this point that is a worry. But definitely the inflation monster, as I put it in quotes, that could be a trigger for a scare. What else is happening in the last 1.5 years? Growth is back. You can see inflation is back also indicates growth is back. So these are all Indian data, IIP data, GST collection, the power demand in the country, the railway tonnage, which essentially is about the transportation and the freight market indication. And NONG stands for non-oil, non-gold exports. This is your net exports, export minus import. From the import, two things have been reduced, oil and gold. I hope you're aware, oil plus gold is 41% of our import basket. Oil is 26% of import basket. Gold was 14% for the last 3 years average. We are 40% plus gold plus oil import. We are obsessed with gold. Indians are obsessed with gold, is not changed even in the last couple of years. The prices are not indicating that. That is largely because, again, a lot of supply also comes up. But the non-oil, non-gold exports, if you see that red line, all of these indicators are much better than the pre-COVID era, which means the activity is picking up, economy is coming back to normalcy. Obviously, starting January, we now have a new wave of Omicron cases. As of now, nobody's expecting it to be very, very disastrous like the second wave that we saw in March, April 2021. Nobody's expecting it to create a major disruption. No major lockdowns are expected. If that happens, of course, the growth engine will again stall. That's not the base case assumption. I told you in the beginning, I'm assuming certain things. Assumption number one, growth will normalize and we will see continuing growth going forward. Assumption number two, inflation will be higher, but it will not become scary or double digit in the coming cycles. Growth needs credit. We need lending. We need bank lending. This is a very important data for India. Always remember, if you want to predict what will happen to economy, look at what is called as credit growth data, which is the total credit loans given by banks. So what we're essentially saying is banks lending, is it back? You can see when the growth was slowing down, the credit growth also slowed down. This was the NPA era. No new loans were given. Banks were cleaning up their balance sheets and all that. Last 3 or 4 quarters, the loans are back. You can see after kind of basing up, the loan growth is going up, and loan growth usually goes with economic cycle. So if you look at any economic cycle of India, loan growth is typically the trigger where banks are comfortable lending, businesses get liquidity, they use it for whatever capacity expansion that they want to do, and automatically they will be able to see economic activity. So the loan growth cycle, I believe, is turning, which means with the low interest rate base, a lot of lending is going to come up, is what my base case is. You can see on a year-on-year basis between October 21 and October 20, most loans have seen a pickup, especially SME loans. Government created a lot of schemes, if you know, to support SMEs and smaller companies, and also the infra loans connected to roads and ports. Those loans have also gone up substantially. Most of this, as you can see, has risen by double digits. This indicates that there is lending happening. When does bank lend? When they're comfortable lending. What does it mean? They are able to see that income levels are rising of the borrowers and their NPA book is under control. So it's like a new cycle which is getting created. I repeat, our slowdown cycle of the economy did not start in 2020. It started in 2017. So typically in India, we have a 5 to 7 year cycle. I think that slowdown cycle is anyways was supposed to kind of stop now. COVID just created a bigger fall, but we are now trying to create a base and probably recover over the next 3 to 4 years. That's my base case. This is banking liquidity. Banking liquidity means how much extra money does banks have to go and lend. That is 8 trillion rupees. 8 lakh crore rupees is lying around with banks, which they are just parking in money market. All this money can effectively go into lending when they become comfortable with the growth, which means companies earn more, they're able to pay interest, automatically I will be lending more. The interest rates also, as indicated by call money, is at record low levels in India, which means from here on, we will increase the interest rates gradually. Loan book will also go up. One of the sectors, which I will indicate later also, which will definitely benefit from all this is the banking sector. So within that, large banks from a stock market point of view is a very good sector to be in for the next few years. Very important ratio, which shows you credit ratings indication, credit rating. These are ratings given to borrowers, right? There's an upgrade to downgrade ratio that this chart is showing. How many rating upgrades happened divided by how many rating downgrades happened. Rating upgrade means the prospects are looking good for the borrower. Rating downgrade means the credit rating agency is not comfortable with the borrower. As you can see, from the second half of 21 going into 22 and continuing, the upgrade to downgrade ratio has been very, very impressive, which means that the defaults have stopped, rating downgrades have come down, many borrowers are getting upgraded by the rating agencies, which means their ability to borrow goes up. Banks have a lot of liquidity. That's a good marriage to have. Banks want to lend. Borrowers are in a better position to borrow. That can be a good marriage, which can create a lot of growth in the economy. So the second sector which will benefit to my mind is infra. Infrastructure will benefit a lot from this growth cycle that we are going to see in the loan book. So look at leverage sectors, sectors which will benefit from loan book going up. One is infrastructure. Within that, power and cement specifically are two sectors I believe will do very, very well. Banking, obviously, because they expanding loan book means their business is doing well in a rising interest rate margin. So the margin is also improving and they are giving more loans also, is a very good scenario for banking stocks, obviously. And one more sector which I think you already would have seen the uptick, and it will continue for the next few years, is real estate. I think real estate stocks will benefit a lot from the leveraging that will happen. People will take home loans because they're at low rates. Economy is improving. Jobs are coming back in a big way. You can see the kind of salaries which is given to technology sector employees, for example, in India as we speak. There's a genuine shortage of quality labor that we are facing around us, which indicates that there will be a good demand for houses. I am not predicting whether it will go up in a belt like Mumbai or Chennai or Bangalore, but as a sector, I'm not talking about investing in real estate. I'm saying the real estate stocks will definitely benefit from this situation. 38% of central banks globally. So each country has one central bank. We have more than 240 countries. 40% of those central banks have already started increasing interest rates. Fed is not one of them. RBI is not one of them, but I'm sure you're reading the newspapers. Both Fed and RBI will increase interest rates going forward. This is being mentioned by many as one of the concerns of the rally stopping. They will say when interest rates go up, as I mentioned earlier, a lot of money can go into deleveraging, and that could trigger a crash in the equity market. I don't have that situation or a scenario in my head at this point in time. This is Indian government security yield, 10-year government bond yield of India. As you can see, somewhere in the middle of 2020 itself, the bond market predicted that the rates have bottomed out, recovery is going to come. As you can see, the 10-year yield has started to go up. Always remember, the longer term part of bond market yield goes up always before the actual rate increase happens. And I personally believe that the actual increase in the long-term yield has kind of literally crossed all rate expectations. So they've already priced in 1% hike in interest rates over the next 1 year already. Maybe RBI will not increase the rate by 1%, but the long-term bond market is already expecting a 1% rate hike. So it creates a very interesting opportunity, which I'll talk about later. Just remember, the long-term bond market yields have gone up substantially in the last 6 to 8 months. How about the valuation concern? People have been talking about high valuation. It's as I said earlier, also market cap to GDP is record high, PE is record high. What do we read about that? So let's look at the valuation concern. This is Nifty's price to earning ratio for the last 21 years on a monthly basis. Nifty, the value of Nifty divided by the earnings per share, Nifty EPS of all the 50 companies weighted average. This is called Nifty price to earning ratio, which you would have seen a lot of fund managers talking about. So you can see in 2020, when the crash happened, Nifty P ratio went to something like 20 times. Then the rally happened, we went to 31, 32, 34. Remember, you saw that Sensex P chart also, we went to 37. We started 2021 at a record high valuation of 40 times PE. We have never seen 40 times PE. Look at the history. Look at these red. Red means historical sense overvaluation. Red means overvalued. You can see where these red marks came: 25, 26, 28, 27. And we were talking about 41 price to earning ratio in the beginning of 21. Yet, I hope you remember, the rally continued and the rally was quite significant even in the last year. Now, I am not saying that is why I'm saying rally will continue. I'm just saying that the valuation concern was there even at the beginning of 21. In fact, today we are at much better valuation as compared to where we were 1 year back. I must add something. Starting this quarter, where you see the data suddenly going from 40 to 29, 28, National Stock Exchange, which gives this data, the source is National Stock Exchange, they converted their PE ratios logic. For EPS, they used to take standalone EPS of the company. Standalone means they will only take Tata Motors EPS. That's about it. They will not take any subsidiaries EPS. From last year onwards, they have started reporting consolidated EPS. So they take not only the company EPS, they also add the earnings per share of all the subsidiaries of that company. So if you imagine 50 companies, EPS is X. 50 companies plus their subsidiary. Obviously, the EPS is much more. So the price to earning ratio has gone down because of that also. So if you have to now compare a 25 times PE, don't compare 25 with 40 because 40 is standalone. Compare this 25 with maybe a 28. This is standalone. A 27, that is standalone. So if you look at it, unfortunately, the data calculation itself has changed starting middle of last year. So are we at very high valuation levels? I will leave it up to you. See, I'm not here to necessarily give a kind of a prediction. I'm just telling you how my thought process is working at this point in time. And maybe, hopefully, you will also have thoughts which you will share with me eventually. This is again Nifty valuation ratio called price to book. So there is price to earning and then there is price to book. As you can see, during the 2003 to 2008 mega bull run, the biggest bull run we have seen, which lasted 5 years, the price to book had crossed 6 times also at the peak. I mean, again, it was a era where people just started not talking about valuation at all. However, you can see where it started. Even when it started, it had already crossed 3 in 2003 itself. Yet, it kind of kept on rising and went to 6 times plus. Where we reach now in this cycle, we have not even crossed the previous average highs. That's called one standard deviation band of the average. We have not even crossed that. So every time it has went there, it has corrected. Went there, corrected. So this is very healthy. A gradual up move is what is a sustainable bull run. We don't want a 3-month rise and a 6-month fall. Every time it goes up, profit booking happens. But don't forget what I said, new money is coming in. There are a lot of people waiting on the sidelines who has missed the rally in 2020 and 21. There are a lot of college students also who has just started earning money in last 1 month. Let's say they also want to come in the equity market. So they're like every correction they're entering. If this continues, you might see what is called as time correction, which means Nifty may not go up by 50% suddenly, but it will be chugging along at 12-14% gradually, which is a very plausible scenario. Again, a valuation concern. Whenever Nifty price to book has been more than 3 times at the beginning of a rally, it does affect the forward returns for the next few years. So for example, if Nifty price to book is, let's say, more than 3 times, and if you invested at that point in time and it was already above 3, the next 3-4 years and 5 years returns is not double digit, it is only about 5-6%. But understand, even if it is 2 to 3 band, the returns are absolutely magnificent. If you ask me, I'm very, very happy with the 10 to 12% Nifty long-term returns. If you ask me, I am not expecting a 25% Nifty returns in the long. I'm very, very happy if in the next 25 years, I can get 10 to 12% Nifty returns. So even if the valuation is 2.5 times PA price to book, the returns have not been bad. Of course, if you can get a correction like you saw in 2020, just enter, because then, and this is proven in history, every time you invest after a correction, the next 10-15 years CAGR is awesome. So people have missed that correction in 2020. Many, they sold out much before that. They just could not enter because the rally was sharp and they waited and waited and waited. Every time a small correction is coming, liquidity is coming into the market. Will it continue? I don't see a reason why it should suddenly stop. So, as I already told you, my base scenario is the party can continue, may not be as loud as 2021, may not be as fun where 90% of stocks were doing well. It might be becoming selective. It might become more sector specific. But if you are in the market, I still believe you can expect double-digit returns from equity over the next few years. At least till there is one major trigger that comes, which could be, I don't know what, 3rd wave, 4th wave, 10th wave, 100th wave of COVID. I told you earlier, I have been over the last 1 year validating this hypothesis. Are we in the 2003 to 2008 kind of a rally where we have just crossed the first year now? Do we have 3-4 more years to go? So I'm just comparing what happened in that scenario and this scenario. The second thing which I'm looking at is, when interest rates go up, when Fed starts to increase interest rates, when RBI starts to increase interest rates, when inflation again goes back, what happens to the markets after that? And are we in a similar situation now as compared to FY13? So if some of you are aware, there was something called taper tantrum, which means the Fed had basically said that now I will increase the interest rates. So if you look at Indian macro structure then and now, in most of the parameters, we are in a much better situation. So the starting point now, when US will increase interest rates and that de-risking may happen, macroeconomically speaking, we are at a much, much better level in most of the parameters, except public debt, which means government borrowing. Because of COVID, government borrowing has been very high because government has spent a lot. Other than that, most of the parameters, especially the foreign currency reserves we have, is at absolutely comfortable level. Meaning, let's assume there is a more than expected rise in interest rate, leading to a lot of de-risking. We have more cushions to beat that, is the point I'm trying to make. Also, this interesting chart is what I was looking for and I got it. What happens to equity market when the US is increasing interest rates? So after a cycle of correction, if US increases interest rates, are we really concerned about that, or should we be concerned about that? You can see in previous cycles, the red bars that you see is the US federal funds rate, which is like our repo rate, their benchmark rate. It has gone up in these cycles. If you can see, it has been highlighted in these boxes. The same period of time, the equity has also done well. As you can see, it's not like when the interest rates went up, just because of that, the equity crashed. No, rising rates was an output to rising activity, rising GDP, rising earnings, and that also helps equity market. So what probably is going to happen is economy will recover, jobs will come back, as I said, and that will lead to a lot of corporate profitability. And if there is corporate profitability, there is no big reason why the equity market should not do well. This is India's policy rate again. So if you look at the 2003 to 2008 mega bull run that we saw, even in India, the rates were going up during that period of time. It went up from 4.25% to as high as 7.25%. So even in that 4 years block, rates were rising, yet Indian equity was doing well. So even in the next 2-3 years, if rates go up, that need not be the trigger for a major correction, is what I'm trying to indicate. This is Nifty earnings per share chart shared by Motilal Oswal. The earnings CAGR from 1997 to 2020, the earnings compounded growth rate, EPS, was 8.3%. And Nifty's compounded growth rate for the same 13 years time frame, 1997 to 2020, 23 years time frame, was 10%. So it's almost like sync. In the long run, we say fundamentals work, right? So even if in 1 year Nifty goes up, even if there is no earnings, in the long run, you only go up because earnings go up. Only when companies do well, you end up paying more for the stock. So if you see, the CAGR for the 23 years time frame is more or less in sync. In between, obviously, Nifty has done well even when the CAGR has not done well. And that was the last 5-6 years. The CAGR is only 4.2, but Nifty has done very, very well. If you see, Nifty's returns have been very good. But over the last couple of quarters, we are already seeing the EPS going up. You can pick any analyst research report, Motilal, UBS, Credit Suisse, anybody, Morgan Stanley. I have not collated all the research reports data, but if you see it, most of them are expecting double-digit increase in EPS. Now, even if it is not 26% that Motilal is expecting, even if it is 10-12%, it is much better than what it was for the last almost 15 years. So when, and again, if you look at that period of 2003, 2008, that's exactly what happened. The earnings caught up. And when earnings catch up, you will see the Nifty also catching up because of that. So my base case now is corporate profitability will improve. And that will be a very big support for Nifty over the next at least 2 to 3 years. This is corporate profitability as real data. This is green line is the total profits of Indian companies. The red line is the losses. So if there are, let's say, 1,000 companies, 900 are in profits, 100 are in losses. That's the absolute figures. And that blue line is the net profits minus losses. If you see the net, we went up again 2003, 2008. You can see this, that the expansion of EPS happened then. Since then, the EPS have only gone down. The profits have only gone down again as a percentage of GDP. This data is as a percentage of GDP. So it has slowed down, slowed down, slowed down. It has reached the point. Now, if you see over the last 3 quarters, it is again picking up. Now, the validation that I am looking every quarter when profits come is this continuing and will we have this cycle again? Because see, investing is about looking at data, trying to reach a hypothesis, and then every time a data is coming, either adding to that hypothesis or correcting yourself. See, you can't be egoistic and say the data has to agree to me. No, you change if data changes. My base case is there is, in multiple ways, I'm trying to say there is a very, very possible situation that we could be at just the second year of a 5-year bull run if corporate profitability can catch up. Yes, there are risks. Obviously, I'm not saying there is no risk. Risk is there. Obviously, risk is there. Now, given this base where I am talking about economic recovery will happen, interest rates will go up, inflation might not be a big trouble, at least in my analysis. Liquidity is still strong. New investors are entering the equity market in a big way. There is a lot of optimism that we are seeing, and that may probably continue if the corporate profitability data continues. Now, if this is the situation, and we have seen euphoria over the last 2 years, do we have to reinvent the wheel about investing? Is it time to learn, new techniques and all? The answer to that is, to be honest, no. We should stick to what we have been doing and what advisors tell us to do. Stick to basic principles of investing. And what are those basic principles? The first is, if you're investing in equity, invest for long term. And you might find it like a mantra which has been said again and again. But when you look at this data, how can you negate it? How do you look at this data and say long-term investing doesn't work? What is the data telling you? Data is telling you, if you started investing in 1995, if you invested in 1995, from there, 1 year returns, from there, 2 year returns, from there, 10 years, if you can see, from there, 10 years, from there, 15 years, from there, 20 years, and from there, 27 years. Because from 95 till 2021, there has been 26, 27 years, right? The CAGR, this is the compounded annualized growth rate that you see, is 9, 10, 11% of whatever you see. The green indicates double digit, yellow is single digit growth, red is negative. So if you invest for 1 year, 2 years, 3 years only, and when you start in most of the years, even that 1 year, 2 year, 3 year, there can be negative returns because that's short term. Start in any year in the history, any year you start, you invest for 5 years plus. This is the 5 years plus mark if you see. And if you invest for 5 years plus, you hardly see any negative returns in equity. So the principle of long-term investing still continues. However, if you are expecting 15, 20% kind of returns, that is not going to happen. If you look at most of the long-term returns, it is 13, 14% in the history. It probably will come down to 10 to 12% going forward. Remember, as a country develops, the GDP grows, inflation subsides. Over a period of time, inflation level goes down. Many of us have lived in India where inflation normally was 12, 15%. Normal inflation was 12%. Most of us, or many of us, have seen in India where interest rates were double digit. I hope you're aware of times when you could get 11% from a government bond. Why? Because inflation was high. From there, we have seen moderation, and that will continue. 5 years down the line, 10 years down the line, 20 years down the line, India's inflation would be moderating, not going up, because the country keeps on progressing that way. In US, 2% inflation is normal. In India now, 5% inflation is normal. But we will also reach a point where 2 or 3% will be normal. Meaning, the returns that you will also get when rates are going down and inflation is going down, returns will also moderate. So the long-term expectation from equity, if you're doing retirement planning, if you are planning for long-term goals, please don't plug in a calculation of 15% and all. Very difficult to achieve it. Keep a number of 10% would be my humble submission. Second principle is principle of diversification. Still works. This is global asset classes returns from 2007 till 2021 global in different asset classes, small cap stocks, large cap stocks, emerging market equity, developed market equity, commodity. You have a lot of these asset classes, and there was a similar chart I will show you for India also, which basically says that no specific asset class continues to do well or continues to do badly. You will be God if you can predict every year what will be the best asset class next year. Like every year you can know, okay, next year is a small cap year. Then you invest in small cap in 2013. Then you realize that next year would be for REITs, real estate investment trust. Again, you realize that next year would also be REITs. It is impossible. So this line that you see in between that goes through is an equal weighted portfolio. If you would have just invested in all the asset class properly diversified, your returns would be, as you can see, obviously not as high as the best, but it would still be closer to the average in most of the years. So diversification principle is still continuing. Nothing has changed even now. This is India's quilt. Bhuvna had written a very interesting article on this, which is available on LinkedIn if you go and follow her. She wrote a very interesting article about the same thing, that allocate money to different asset classes. You can't be God and pick up the best asset class every time. And here also, if you would have just diversified, your returns would be more steady with lesser volatility. That's important because you can't be jumping from plus 30% to minus 20% every time. So the principle of diversification asset allocation should continue. I am not saying you can be all in one asset class. So what do I think is the way forward? What do I think investors should do and what I will be advising my investors for the way forward? First, and this is very, very important, do not overestimate returns from equity going forward. If you get a 2003 to 8 kind of a bull run again, count your blessings. Just say, thank you, God. You were, you gave me an opportunity where I could invest in a mega bull run. Karthikeya was mentioning earlier in this chat that he was in school when that 2003 rally happened. Now he can invest. So to anybody who is in this market, be lucky and feel fortunate if you see a mega bull run, but don't assume that it is going to happen because we have to see validity of data. If you meet me after 2 months and if I would have changed my view saying I am now bearish, don't blame me. Maybe the data has changed, because if the data changes, I will change my view. As long as the data is supporting that there is a repeat of 2003 to 8 rally that can happen, then maybe you will get a 20% return CAGR, but the base case should only be 10%. Look at this. These are the world's best investors ever. Ray Dalio, I'm assuming you know about him and he's famous. Warren Buffett. Their long-term returns average is 12 and 20 and 29. Now, don't look at this chart and say, "Arey, that means it is easy to get it." It is not easy. They're legends. They have a team. They have data. They have spent hours and years to generate that returns. Do you think with your full-time job or whatever you're doing on a normal day, by just looking 5 minutes in money control, you will be able to replicate this kind of returns? Let's be humble. I don't think nobody can. So just be very reasonable when we are doing future estimation. Equity, I continue to believe will do well, but not like you can expect 25% CAGR, or not like you pick randomly any stock, it will double. It may not happen. There will be excesses that will be corrected, but not necessarily always in a bad way. Second suggestion, which I would like to give, and I said it's not investment advice. I am convinced that in the mutual fund space, very few large caps are worth investing into, large cap funds. I am convinced that passive investing, especially in the large cap space, is the way to go, which means invest in passive funds like index funds. You can see this data. You can see this data here. 1 year returns, 3 year returns, 5 year returns, 10 year returns, going back from December 2020. This data of 80%, 88% is what is data? This is the number of large cap mutual fund schemes in India, which was outperformed by the benchmark. Meaning, in a 5-year horizon before 2020, so for a 5-year returns ending in 2020, 88% of large cap mutual fund schemes underperformed the index. 88%, which means only 12% outperformed. So what are the odds that you are in that 12% large cap fund? Very, very difficult. So at least in the large cap space, I may not say that for mid cap and small cap. You can see in mid cap, there is a lot of outperformance happening by the mutual fund scheme. In small cap also, but definitely for large cap, and this is what we practice also when we give a investment portfolio to our clients, I think it's time to stop looking at pure large cap funds actively managed, save on the expense ratio, come to index funds. Now, within passive investing, this is a very important message which I would like to give out today. I am still a big believer of index funds over ETF, exchange traded funds. I'm not getting into concepts today, to be honest. We can do a separate session on index funds versus ETF. Both are similar, both are passive. Index funds is where you invest and redeem directly with the mutual fund. ETF is a secondary market concept. You have to buy and sell units like a normal stock in a broking platform like Zerodha. Normal day, ETFs look okay. They will mirror the index. You can see there is a black line here and there is a green line here. I don't know whether you can make it out. It's almost overlapping throughout, except, and that is what I'm trying to tell you. Look at what happened in March 2020. This time frame, this March 2020 time frame. You know what happened? Markets was crashing. When markets are crashing, Nifty is going down. When you want to sell your ETFs, ETF is like mirroring Nifty. You have to sell in the secondary market. Now markets are crashing. You have to sell some Nifty holdings. There are no buyers sometimes. There are no buyers because everybody is bearish. And what happened in that crash? This black line is the ETF NAV, ETF returns. And this green line is the index. And you might think, oh, it is not a big difference. On the day of that major crash, I was there in the market. Nifty Bees, the ETF, one of the most liquid ETF is Nifty Bees, Nippon. That was a discount intraday of 9% to Nifty for about 1 minute. So if you are selling in that 1 minute, you're getting 9% lower returns than the index when you're selling. It's a distress sell. In a distress sell, you don't get buyers at fair value. Try to sell a real estate property under distress. Try to sell a real estate property urgently, like in 1 day you want to sell. You know how much discount you have to sell it at? Same way, ETF's problem is secondary market liquidity can dry, not on a normal day, but on the day when the market is crashing. And believe me, that's the day you want liquidity. I still in Indian equity prefer index funds because in index funds, you're redeeming from the mutual fund directly. They have to give you the money back. There is no discount to the NAV you have to tolerate. In ETF, that happens. So I'm a big believer that Indian ETF space, except maybe Nifty Bees to some extent, doesn't have enough liquidity for us to invest in passive funds of clients into that. So this is, yes, I want to go into index funds, but through index funds, as in passive through index funds, not through ETFs. The second message, or third or fourth or whatever, I'm not counting, is the value stocks and the value investing game is not out. In fact, 21 is already proven that value investing still works. So this is a simple comparison of how the value index of MSCI, MSCI is Morgan Stanley Capital Index. So value index has value stocks. Value stocks are usually large cap, and growth index has more of mid cap and small cap kind of stocks. And you saw that the value stocks were outperforming already in 2021, and this trend will continue. Quality stocks will now do well. It won't be a broad-based rally where randomly you pick any stock and will do well. That is not going to happen. But value investing is not dead. One of the questions that Bhuvna alluded to in the beginning introduction was, do we still look at valuation? Yes, we have to. There will be time correction that can happen. Quality stocks you should pick. But when a stock is trading at 120 times price to earning, you have to be careful. You cannot just randomly pick that stock and say, oh, you know what, this will still give me returns. That probably will not happen. So value investing is still okay. Of course, the concept of value is subjective. So you may think something is overvalued. Somebody else may think it is undervalued. But the theme is not dead. 2020 made us believe that no valuation is going to be logical. I don't think it is the case. Valuation is still important. However, doesn't mean that you just shun the growth angle. Look at the data more closely. Earning returns will become more difficult. It won't be so passive that any stock will do well. So it will become difficult, but there is returns to be made in value stocks as well. This I have been saying to my clients for a long time. Some of us may not like it. I personally, remember that first disclaimer, personal view, gold is a totally overhyped asset class, especially in a crypto environment. So I do not recommend gold in any portfolio. unless you want to wear it as jewelry. That's personal. From an investment point of view, the so-called hedge against market crash, I don't think is working anymore. You can see over the last 12 years data, gold and Nifty is directly correlated, except probably a small phase in the last 6 months. Otherwise, there is absolutely no reason to indicate, for me at least, looking at more and more data, that gold is an asset class. No, it's becoming more a consumption thing. We are importing it a lot. There is no investment thesis I can form where I can say, you know what, it has to be a part of your core portfolio. I am not convinced on that. If somebody still wants to invest in gold, you want to, maybe sovereign gold bonds could be useful, because at least you will get 2.5% coupon. Plus, SGBs become tax-free after 8 years, a huge advantage. Otherwise, I am of an opinion that gold is absolutely not a part of any asset class I would create or any portfolio I'll create. Rupee will depreciate is another view I have for the next few months. Now, when I say depreciate, I'm not saying it will go from 76 to or 75 to 80, but yeah, there will be pressure on Rupee for a simple reason that when, again, my base case is growth will come. When growth comes, economic growth comes, we get into what is called as current account deficit. Again, I'm not getting into too much technicalities, but current account deficit means we become net importers. So we are already net importers, but that is largely to do with oil and gold. Even if you ignore that, we were net exporters, as I showed you in a chart. We will have pressure on Rupee because of that. We will also have pressure on Rupee because of some short-term maturities that is going to happen of our external debt. So if you see, this is the external debt which will mature 1 year from these months. 1 year residual maturity external debts. These are in billions of dollars. Meaning, for example, as on December 20, within 1 year, within December 21, $252 billion of external debt. External debt includes external commercial borrowings, some money that government has borrowed from outside that has to be repaid. Now, obviously, government tries to roll it over. They will try as much as possible to, repay by borrowing again. But even if there was to be some redemption, that can result into a little bit of pressure on Rupee. One good thing is, which will result in not a significant depreciation in Rupee, is our FX reserves. We have more than $650 billion of reserve. RBI can use it. RBI can sell those dollars to meet the redemption. They may not necessarily want to create a panic. So what I expect from Rupee is it will depreciate over the next few months, but that would be a good opportunity again. If you're exporters or if you have some clients who want to enter currency, you can again sell dollars at that point in time. It could be a range bound market over a period of time. But from now, maybe in 3 months, 4 months, I think there would be some depreciation on Rupee. So what does it mean? Tactically, if you want to play a higher education goal investing thing, you might want to look at dollar assets. Remember, when Rupee depreciates, that is dollar appreciates, dollar assets do better. You will get better returns in that sense. So as a part of your core long-term portfolio, do consider US equity as a part of it. So I'm sure most mutual funds now have a US ETF or a US index fund, either S&P 500 or a NASDAQ. You can definitely consider that, because as Rupee depreciates, it will. Over the next many years, Rupee will continue to depreciate. That will do well for your foreign education goal. If you want to send your children to US or UK for higher studies, create an asset in foreign currency. That will do very well for you. Cryptos, the most common question I was asked in the last many years. I'll take, by the way, just 5 more minutes. What is my view on crypto? First of all, crypto is not a regulated product in India. So officially, I cannot give a recommendation to any of my clients on crypto. I'm SEBI-registered. But my view on crypto is it is still not a reliable asset class, at least for me. I am not convinced that crypto can be a part of your core portfolio. I am not a believer that we will see a world where crypto or virtual currencies will become a replacement for traditional currencies or gold. I don't think that is going to happen. I cannot imagine a world, call me stupidity, call me whatever. I do not imagine a world where crypto will be mainstream. I don't think so. What can it do for your portfolio? Create a lot of volatility, and of course, give some returns which can be very, very high. If you have some income which you can afford to lose and it's not a part of your core portfolio, you can probably get into cryptos with that. I will not be comfortable recommending crypto as a part of any core portfolio. You can see the volatility of cryptocurrency, which is Bitcoin. This is on Bitcoin. You can imagine if this is Bitcoin, what could be Dogecoin and whatever coin that is coming up every week. One of the interesting theories that cryptocurrency fans tell me is the supply of Bitcoin is limited. So because the supply is limited, there will always be a demand and the price will go up. The problem is that the supply of Bitcoin may be limited, but there are new cryptos coming every day. There is new and new Bitcoin type creating every day. So automatically, even if one is limited, there are 10 more coming up. So I don't think as a concept, cryptos have limited supply. You can see this is S&P 500 index, gold, commodity, fixed income, dollar. You can see how their volatility is over the last 10 years. Volatility is movement, standard deviation. And you can see where is crypto. Now, with this kind of volatility, I am not comfortable putting it in my mainstream portfolio. I may dabble into it. I may put 3-4% of my wealth into it. Will it be a mainstream asset class? I don't think so. I am not a believer in that. The last thing which I believe is it is time to consider startup as a part of core portfolio. I have started doing it for the last 4 years in my portfolio. I've been advising my HMI clients on it. I personally believe that the next 10 to 15 years, you will see a very, very big traction in the startup ecosystem. I already told you how unicorns are being created in India in a big way. I think Indian entrepreneurs, especially the ones who are in B schools and engineering colleges today, they have cracked. They know there is liquidity, there is knowledge, the brain drain is going to stop to some extent. They are not getting into Apples and Facebooks and Googles and say, you know what, I'll work there. Many of them are staying back in India, creating something in India, and most of them are tech related startups, either fintech or edtech or prop tech or health tech. There is a tech angle, and India has been a tech oriented country for the last 25-30 years. We have been supplying tech brains to the rest of the world. Look at the CEOs of all these big tech companies. Now, because there is so much money in India and there's a big startup ecosystem which is getting created, accelerators are there, I'm a part of it. There is a lot of belief in entrepreneurs that I will get the required support in India. I don't need to go to Silicon Valley. That belief, I believe, is going to create the next 10 years of a good startup ecosystem. Start looking at it. Reach out to me if you want to see how to go about it. You can invest in startups now like you invest in mutual funds, as less as 2.5-5 lakh rupees. You can do that. It's not like a 1 crore investment kind of a thing. So even with a small money, you can get into startups. Reach out to me if you want to know about that. So as I said, Indians are creating a lot of unicorns now. We have overtaken UK. We are obviously behind China, but in terms of new unicorns created last 2 years, we have beaten China also. China and US are not a joke in terms of entrepreneurship. We are giving a tough fight. We had talent, nobody doubted it, but there's an ecosystem for startups now. Government is also helping, and the entrepreneurs are also coming together in many, many ways. So let me stick my neck out. Last 1 minute. I can be totally wrong. You can hold me responsible for this after 1 year. I think inflation will not ruin the party. I think interest rate rises will be smooth. There won't be any abrupt shock that will happen in the cycle. I think the corporate profitability that is going to improve, and the capital expenditure cycle of the government, which is also improving. I think these are the two main triggers where I am continuously every week seeing whether we will have a repeat of the next 5-year cycle. I still believe equities will outperform most of the other asset classes. If you get a dip, for whatever reason, there can be a dip, get into it. If you see a correction, get into it. Sectors that I believe will do well because of the interest rate leveraging cycle: real estate, banking and financial, infra, especially within infra, I would say cement and power to be more specific, and technology. Rupee depreciation works well for technology, and companies like Infi, TCS have metamorphosed their entire business now, and they're doing extremely well. I would want to stay out of commodities and metals for the next few years. I don't think there is a secular rally coming on that space. Short term, yes, you might see gold probably touching $100 very soon. it's at around 82, 83. It can cross 100 in the next maybe few months, but I don't see a secular commodity rally happening. Long-term yield I mentioned is already up. 10-year yield in India is 6.5 plus. Gives a good opportunity if you want to enter long-term debt funds. A long-term gilt, long-term dynamic. It's a good time to enter those funds now. Long-term. Short-term rates will go up. I think the long-term has already gone up and it is not going to go up further in a big way. So maybe 10, 20 basis points more, but I am not seeing 8% on the 10-year yield in India. What would I keep in my model portfolio if I were to? My core book will have certain bank FDs for emergency funds. Liquid and short-term debt may not be that big. There are banks which is offering you 5 and 6%. Why not that for emergency funds? I would invest in floating rate debt funds for the next 1 to 3 years because interest rates will rise. So floating rate bonds coupon will go up. I would want to consider good quality corporate bond funds and debt ETFs, even REITs for 3 to 5 years. And for longer term, I would consider index funds, including US index funds, multi-cap. I think there's a lot of value in quality mid-cap and small cap. Satellite means if you want to take some risk in the short term, I would look at startups. A small part of your portfolio can be there. And dynamic bond funds. Dynamic bond funds is where you can kind of trade in the bond market. The fund manager will do it. You cannot. But there is a lot of opportunity there in terms of making some short-term returns. And very tactical, more opportunistic would be currency. As I said, I can play the currency view where rupee depreciates and it stays there. EV theme can give some short-term opportunities. I like real estate stocks because of the reasons I mentioned. And I think, and this is something which is very, very important, as advisors, as investors, keep looking at hedging opportunities if equity gives you an outsized returns. So let's assume this year also Nifty goes up by 20%. Let's assume. So your equity portfolio would definitely be 100% plus in the last 2-3 years. Look to hedge it. Hedging cost by buying Nifty put for a 1-year horizon is just about 4 to 5% if you do it well. I think it's worth paying 4% if you have got 100% returns and you're sitting on it. So consider hedging as a very tactical thing. We do that a lot in our team, and Somalu's on this call is an expert in derivatives. That's where I stop. I overshot my time. I'm sorry, Bhuvna. I'm sorry, everybody, but that is where I'll stop. You can contact me or Bhuvna anytime. I'll stop. Any questions I'll be happy to take. Sorry for taking long. Thank you so much.
Don't say sorry. I think we didn't even realize that you overshot time. So what do you guys think? Was that useful? I think it was, when I saw the presentation, I thought this was just a lot of stuff, man. How is he even going to handle this? This is just too much, but it all came off so well. And I think the theme of saying that we're probably somewhere in the first or second year of the bull cycle, amply established. And your views on various asset classes also, I think, have come across beautifully well. So guys, if you have any questions, so there were some few questions, Harish, you want to take them? So let me just go from the beginning.
It went up a lot.
Yeah. So Sriram was asking, it's an investment in startups, predominantly funds coming from outside the country.
Both. So I actually deleted that data because there was too much data. A lot of money is coming from overseas funds into Indian startups, but it is so in the second half of 2021, Sriram, Indian funds have Indian. When I say Indian funds, I am not just talking about Indian PE funds. The overall money raised within India has surpassed the money that came from outside. And I think that trend is going to continue. Just like you saw how domestic secondary market liquidity is overplacing FII money, same thing I think will happen in the ecosystem also for startups. So last 6 months, domestic money was more than foreign money coming into startups.
Okay. Tirupati Roy was asking, can you elaborate on the retail rally of 2021? So you were covering one particular slide where you said retail investors have actually have been part of the rally of 2021. So Tirupati, do you think that needs some elaboration, or are you good?
Yeah, thanks, Bhuvna. Same thing. Just I wanted to know that in front of big institutions, how retail, because we are often hearing this line that retail has major participation in the last 1.5 years. For example, Zerodha opened 2 million account in the last decade, but Zerodha opened 6 million account in the last 18 months, something like that. So my question is that in front of institutions, how retail can create impact in the market. That is number one. And one more question, just I'm adding, Harish ji, if you can help us, that this is we have keep on reading that whenever retail is gung ho, right, in equities and all, so that is the time to sell off and all that, right? At this time, really, our investors also keep on telling that we are doing very good in stocks and all that. So retail is very comfortable at this moment. Is that a risk part? That is the one risk I'm seeing from my learnings of last 15-20 years. If you can elaborate, please elaborate. Yeah. Thank you.
I think probably you got locked out at that point because this was the exact specific thing which I pointed out, that historically everybody says when retail enters, that's the time to run from the market. So this is that same chart. So if you see the quantum of buying that came from retail, it has not only been able to fight or offset the FII money, it has been multiple times bigger than that in the last 18 months or so. Also, as I said, this time, and this was the answer to the second part of your question, it's not just in the previous cycles. What used to happen was the total number of retail investors investing in the market were largely the same. So for example, if you had, let's say, 2 crore demat accounts at some point in time, it was close to 2 crore demat accounts for 4 or 5 years. So that same people who would invest a lot of money would kind of enter at the time when market has gone up a lot. Then the markets crash, they all take out money, then they will enter again. So there was no fresh money coming in. It was the same money rolling, if you understand. Last 2-3 years, if you see, the number of new demat accounts created has been very, very high, which basically means new money is coming in. So for example, if I have been investing for the last 15 years and I exited this month, if you are a new investor entering today, you are putting in money today, right? That is creating a replacement effect, which is different in this cycle as compared to the earlier cycles. So that is what I was trying to say, that this time I don't think it's a retail frenzy. I think there is a little bit of strength to the retail rally that we have seen.
Yeah, so it's fundamentally a strong rally, not just the froth, right? There are a couple of questions on EV, your view on EV.
It will, I mean, the electric vehicle space will not pan out. I believe it will not pan out the way people are expecting it to pan out. So most of the people are going and buying Tata Motors and the large auto companies. I think it is not the way to play EV. I think you have to play the EV from a support system point of view. So I would buy, let's say, for example, a Tata Power from the EV story point of view, as compared to buying a Tata Motors directly. Because as the EV sector develops, a lot of valuation increases already happened in the actual end product manufacturers. But the OEMs and the support system, I think, has a lot of rally still left. Secondly, right. I believe that two-wheeler segment in EV will outperform the four-wheeler segment in EV in terms of within the auto component, is my view. So auto, I am overall bullish, but I am more bullish than the two-wheeler segment.
Okay, great. There's a lot of question on startup investing, a lot of interest on startup investing also. One particular question that Jayanta has asked is, do you approach startup investing through the AIFs, the Cat 1 funds or angel funds, or, how do you go about that game?
Is that like a generic way of how I go, or is that specific to me?
No. So how does one assess some of the startup funds which are out there? Some AIF offer Cat 1 AIF as angel funds. How do I know how good they are vis-a-vis other funds? That's his question.
So it's a very large topic in itself to value startups and evaluate them. To be honest, it is not very easy. How to go about it, various mechanisms or various platforms through which you can go is obviously, one is category 2 alternative investment funds that is getting created. The problem there would be that the minimum ticket size would be quite high. So most of them will start with a minimum ticket size of 1 CR, right? So if you're starting to invest and if you don't have a portfolio of, let's say, 10 CR or something, you wouldn't want to put 1 CR directly into a startup fund. I think, especially if you're beginning in this, the best way to go about it is through an accelerator. So there is one way, which is a fund creation. There is another way, which is called accelerators. Accelerators is nothing but a group of investors who come together and do crowdfunding for a startup. There, the minimum ticket size is not 1 CR or anything close to that. It can be as low as 2 lakhs, 3 lakhs, 4 lakhs, 5 lakhs. The startup investing theme is not about picking 2 or 3 startups and then sitting on it. The startup portfolio has to be created in such a way that you need to have a good list of 50, 60 number of startups, because the success rate in startups are very, very bad. So if you want even a 2% success rate that one of your startups will do a 100x on your valuation, you can't invest in 2 startups and hope that one of them will do well. You invest in 50, 60, 70. Now, one way is to go for a fund where the ticket size will be 1 CR plus. Another way is to come through accelerators. There are many of them now where even if you have, let's say, 1 CR, you can actually invest that into as much as probably 25 startups to begin with. And out of that, maybe one of them will be 100x and you can get a lot of returns out of that.
Okay, so I think that pretty much answers most of the questions there. Guys, I hope you enjoyed today's session. Please drop in what Dodgy to the moon. Okay, Kartike is asking for something.
Dogecoin.
Yeah.
I don't have any video.
Yeah. I don't Cap3 long short AI. Okay, so
I mean, you have my number, right? So please reach out separately. You can see my number, WhatsApp me. We can have one-on-one questions. We can have sessions.
Yes. Yes, so thank you very much for joining us today, guys. And I have a request for all of you. So we'll try and bring such very, very valuable sessions to you. But please do keep sharing topics that you would like to hear about. And if you have recommendations for good speakers, please do keep sharing it to us as well. So we can all benefit from the collective wisdom of the group. And of course, we are always there to moderate great sessions for you all. And I look forward to seeing you all once again. And have a great year ahead. Thank you very much for joining us today and enjoy your weekend. See you. Bye-bye. Thanks, Harish. Thank you very much.